What's going on, guys? Brian's here. Today is Thursday, November 30th, 2023. The market is currently open. It's almost noon Eastern time, and I decided to hop on and record a live video showcasing my live risk profile, as well as some positions I have that are expiring here today on the SPX and tomorrow. So I have one iron fly left for today's expiration, and then I have some double calendars that are expiring tomorrow on December 1st. The green line is the T+0 line, so that is my current P&L. I only have one slice on this chart, so this is the current live price of the SPX. This is the position in total. This is the position P&L for the day, and then the white in the background is the expirations P&L. So as the market closes here at 4 p.m. Eastern time, if the SPX was to close at this strike price right here of 4550, P&L will be around $2,500 or so, and then this is showing if the SPX was to sell off a little bit, the P&L will end up being around $500 or so. So that's just a quick introduction to a risk profile in case you haven't seen one before. This is the price action on the chart. This is 455 on the SPY. I'm going to use the SPY as a reference just because it's a little bit easier. Numbers are smaller as they're both derivatives of the S&P 500. Now, as we're looking at this right here, the main reason, without getting into so much of the why, we've had massive consolidation around this 455 strike. If you've seen the previous video in which I did, I released how I prep for the week, and I draw out these gamma exposure levels on my charts. And the 455 level was the absolute gamma strike. It had the highest positive gamma. It had the highest open interest for the Monday, Tuesday, Wednesday, Thursday, Friday expirations combined, and it had also the highest call open interest. So I knew 455 was an important dominant strike. However, I was a little bit worried about running more non-directional trades for this week because the market has been consolidating for a while after we've had this massive rally at the start of November. Price action has been pretty muted, and it's been pretty sticky around these key strikes like 450 here, and then we've had 455. So this is 1, 2, 3. Well, let's just count the days. 1, 2, 3, 4, 5, 6. Going on 7 days now out of 8. This is the only day in which we weren't at 455, but this is still pretty close to it, as we were pretty much 454. So we might as well count this. But to be technical, we're looking at 1, 2, 3, 4, 5, 6, 7 out of 8 days. We might as well call it 8 out of 8 days. Price has just been hovering around the same range. Whenever that's been happening for a while, traders will usually expect an expansion in volatility. Jerome Powell is talking tomorrow, so I will expect some sort of move for tomorrow. Now, with that being said, coming into this week, again, you can watch the previous video in which I've released discussing how I approached the week. So I was aware of the catalysts and what was coming. However, I did not know Jerome Powell was going to be talking on Friday, as when I did that video, I don't know if he was scheduled or it wasn't listed in the economic calendar. So as I was starting this week, the other major strike prices I was worried about or thinking the SPY might want to go to would be 460 or 450. However, I didn't know which direction it would go. So I decided to run a double calendar, targeting up here and then targeting down here. And that's what we see in this profile right here. So 4,500 and 4,600. However, when you run a double calendar, you will have a slope in between. This can be referred to as the death valley, because if implied volatility was to decrease, even if the market goes nowhere, you'll end up with a losing trade. You actually need some sort of expansion, not only in volatility, but you need price to move. So that's always the concern whenever running double calendars. In this case, however, knowing that, I decided to run the double calendar anyway, because price has been consolidating so long around this strike price. I figured towards the end of the week, we might get some sort of a movement without expecting it to go much further than 4,600 and 4,500 because of how dominant of a strike prices those are on the options chain, as well as the high gamma exposure at those levels when I did my analysis. On top of that, usually whenever I run double calendars, 15% I'm pretty happy with. 20 to 25% is usually where I'm going to take profit. So that was the objective coming in this morning. But now I'm in this situation where I can decide to hold for a little bit longer because the market has gone nowhere. At the start of the week, I figured I would want to do something like this because I was concerned of price not going anywhere. So I decided to run this iron fly. I kept the ratios pretty balanced. I'll share a link in a previous video in which I've done before, where sometimes I'll mix butterflies together, mixing different expirations, and tend to get a little bit creative whenever I'm building out my risk profile. In this case here, this is the iron fly. I decided to use today's expiration. So let me just refresh this. So yes, so this is today's expiration. It is now a 0 DTE, but it was opened on November 27th. The same time this was open here on November 27th, which was the Monday. So as you guys can see, I opened this first, and then shortly after I opened this. The reason I opened this is because I wanted a spread that would protect this death valley here if the market was to go nowhere. So if the market barely moved, this spread would benefit, and I kept this position pretty small in relation to this one. So the ratio in this case is for every 6 of these, I had 1 of those. So this is the actual position that I have currently running. So the ratio is about 6 of these. I was essentially looking to protect or hedge this death valley here in the middle, and I figured this was a cheap solution that ended up working out pretty well so far because I haven't closed the remaining positions here. And as we can see, the market is moving. So by the time I'm done recording this video, I'll decide to make a decision. I wanted to hold until power hour. However, if price action remains below 454, I'm not going to compromise or risk much of this profits, as I've already made well over 100% of the margin being used on this last piece here. If I were to pull this and let's just put it on the max risk, so it's about 130% of the margin remaining that it is currently up. The main reason why I wanted to do this video is to first and foremost show you guys how you can mix spreads together and you can mix expirations. Just because you run a double calendar, you can think about what will happen if price does not move. In this case, also, if price was to move, I would not have to be too concerned, because let's just say we did go to 4,500. Again, this will not be a complete accurate representation to P&L because implied volatility will likely contract a little bit if we did go up to here. So if price was to go all the way up to 4,600 and this spread would be up, let's just even pull it down to be even conservative, and let's just say the volatility was going to be around 10%. This spread would be up $1,300. Then let's actually pull this to market close here today, and this would be up about $700 or so, $600 for saying. Again, this is, I'm just using an estimation of a change in implied volatility. And at the same time, if the SPX was to go all the way up to 4,600, and let's just say I held all the way until the close here today, this trade will essentially be dead, meaning it will suffer a $500 loss. However, this trade would be up, roughly speaking, let's just say $700. The moral of the story, that is a net positive still of $200 for every 6 of these holding and every 1 of these being held. And then it creates the opportunity where if the SPX was to stay at 4,600 for tomorrow, the P&L can squeeze out an extra an extra $1,200 or so. And that's sometimes the type of approach and will I want to take. Now, I do want to make it very clear that this type of situation or scenario, in my opinion, it's not something you can be very systematic with, or at least I've struggled to find a very systematic way of doing this. Double calendars have been very flaky for the past 16 months or so. Back in 2020 or so, I used to have a lot more success with these. 2021, things were okay, and then they started towards the end of 2021, 2022, from memories where things started going downhill. Pretty much, especially during the bear markets, they were not reliable. I was able to consistently aim for the 15 to 20% is what I was hitting every week, and at one point I was getting about 25% is what I was aiming for, opening on a Monday and usually before the Friday using weeklies or 2 week out double calendars. Some sort of profit targets would be hit. If I was doing 2 weeks out, I would aim for 10%. If I was doing the weeklies, I would aim for the 15 to 20%, and sometimes would leave a couple runners and aim for that 25%, and it was working pretty well. Again, this last year things have not been going pretty well for double calendars, so I've kind of lowered my expectations for them. So it's been nice to see that this is a week in which it has worked out pretty well. So I do want to let you guys know this. If you're watching this video, this is not a video saying like every week you're going to run out and try to do something like this, because the success will definitely vary. On top of that, the point of what I'm trying to share is understanding the approach at the start of the week. I'm not sure what's going to happen. I'm a little bit for a non-directional trader. Implied volatility is pretty low, so selling volatility is not that great right now. Earlier this year, for contrast, we would be able to sell an iron butterfly as soon as the market opens and can get anywhere from $25 to $30 in premium. So that's $2,500 being collected, or $3,000 being collected for one iron fly. Now you try to sell an iron fly of the same distance at the open, you're barely sometimes getting 20 bucks. I haven't checked. Once it dropped below $21 or so, I stopped being interested in running 0 DTE iron flies exactly as soon as the market opens, because to me the risk is too high for my taste. Especially at that point, I was able to squeeze out about $2 in premium, so I would sell it for, let's just say, 30 bucks, and then within 15 to 20 minutes would be able to buy it back for $28. It was a quick 200 bucks, sell 3 of those or so as soon as the market opens. It was one way to start the day off. Usually within 15 to 20 minutes I would hit a $600 profit target. Again, as soon as applied volatility started decreasing, that strategy no longer became interesting to me, even though I know it's still working. So this is a case here where the market is going sideways, and I was concerned that the longer and longer the market stays sideways, the expectation for a large move starts increasing and increasing. So with that expectation, I don't want to stop running my non-directional trades, because in this is a case where you can have 7 to 8 days of missed out gains for a non-directional trader. So I don't want to miss out on that opportunity. So how do you protect yourself? How do you hedge yourself in advance? That's the main purpose of this video. If we were to take a look now within the Quant Trading App Discord, this is sharing some of the thoughts here at the start of the week. This isn't how I would normally run a double calendar because it's weekly. I started avoiding the weeklies because they became very unpredictable, and I like a little bit more of a predictable approach whenever I'm trading. And by predictable, I don't mean I'm predicting what price is going to do. I mean I have some sort of expectation on how my spreads will perform because I've been running them for a while, specific types of strategies that I have some sort of an awareness for. I know if I run a 45 DTE iron condor and I'm selling a 15 delta or 10 delta iron condor, I know what my expectations will be within 14 to 21 days. I have an expectation for how much my profit should be. I have an expectation for how much the drawdown might be, because it's a trade in which I've been running for a bit, so I have some sort of experience with it. That's what I mean with some sort of familiarity or an understanding for performance. So I'm just saying here, I just used the QTA buy zone to sell zone. So this is for Quant Trading App members. Pretty much these levels coincided in a sense with what the Quant Trading App weekly script was saying should be this week's support and resistance. And then we have a 455 as a major level in the options chain, as we can see from this week's GEX profile. So that was from my notes. Again, this is based on the video that I did on Sunday, which was made public on this YouTube channel here. The start of the week again, 455. And as we continue right along, for all expirations combined, so not just this week. However, price has been flirting with it since last week Monday. I'm running a narrow iron fly 2, but if price does not break away from the strikes of the double calendar as where I'm expecting price to go. So I don't even know if when I'm typing these things, I just type it. I want to get it out as fast as possible, and I'm not even sure if half the time they make sense, because most of the time I don't even double read it. I just type it out, submit it. So there's probably going to be a ton of grammatical errors and stuff like that in these messages. All I was saying is at the start of when I first opened this trade, you guys can see that the slope in between was already below the zero line. So I already knew it was at risk. This is a case here where this is a week where things worked out better than expected because implied volatility has been increasing. I track that with my spreads every day or so. Whenever I get the chance, I will come in and I will actually take note of what's been happening with the implied volatility. So when this trade was first open, you see implied volatility was 9.9. It is currently at 12.2. This is based on the option strats implied volatility, the way they calculate it. Sometimes I will also track what TOS has for the implied volatility. So that's what TIV stands for. So Thinkorswim's implied volatility was saying for Friday's expiration, the IV was 11.48. Monday's implied volatility was 10.8. And now I see that tomorrow's implied volatility has gone up to 15.53. And Monday's implied volatility has gone up to 10.7. So that is good. So the implied volatility has gone up for both expirations. It's not good when it goes up too much by the front month or the Friday expiration in this case. However, it did increase also for the Monday expiration, so that's great for the calendar. You want your long expiration, which in my case here is December 4th. This expiration's implied volatility has increased. Again, that is great for calendars. It doesn't always happen. With Jerome Powell talking tomorrow, that can be one reason why the implied volatility started increasing. So at the start of the week, again, without knowing that, I did get a little bit of lucky because I wanted to run some longer DTE calendars or double diagonals using December 19th and 26th. That's just looking ahead. That's past the next CPI report. I wanted to use in expirations that I was expecting some expansion in implied volatility. However, the liquidity was horrible. There was no volume. This was an hour into the market. I was not seeing any volume going into that expiration. I believe this was a Tuesday expiration to a Tuesday, and that could be one reason it's not a very popular expiration. Let me actually just double check that. I'm going to check my calendar on my other screen. And December 19th. Yes, correct. That is a Tuesday here, and the 26th is also a Tuesday. So being aware of that, I didn't want to open up a position that I get stuck in. Usually I like to use anywhere between $6,000 to $10,000 in these types of positions, especially if I'm going outside of the weeklies. I would like to use 10,000. To use 10,000 for the amount of contracts I would need to get, I didn't really want to be in a position where I would get a horrible fill, and then especially if something went wrong, I will be stuck in the position. So I didn't want to size up into those. So I decided to go with the weeklies, which means if I'm going with the weekly, sometimes I can use less margin. Liquidity is better, but they are inherently a little bit more riskier. Volatility is so low that ironically liquidity tends to dry up. I considered an iron condor for Friday too, but I just couldn't justify how low the credit was to make it worth having for me. I wouldn't want to put a 10K in margin at risk for a weekly iron condor when the implied volatility was so low. But as we can see here, an iron condor would have worked out pretty great this week also, because again, the market has barely moved. In this case here, volatility has expanded, so that ended up benefiting. So another trade I mentioned, going with a double butterflies, I think. And then I said, that's another way to go. So I almost mocked that up, but my gut said to go with the calendar. So this is what I'm saying, where this is the element of the video where I just got a little bit lucky here, because my gut said go with calendars without knowing that implied volatility would increase in which the way it has. Now, experience will tell me that the implied volatility was expecting an expansion. Implied volatility was the way to go, not just because of a little bit of luck. As they say, luck tends to come with experience. It's because of also understanding that the VIX is at the very, I call this just the low lows. This is the lows of the year, or it might be the low longer. Let me see if we actually zoom out here. So I must have marked this. Okay, so I just put this here. This was the low, and if we were to zoom out, it's pretty low. Long story short, low for me just meant, wow, this is pretty low. I know a couple years back there is a level that was about 11 and change, so it has dipped a little bit lower than this. But once we start getting towards this level, I do want to run more calendars, because I don't know when, but the expectation again will be volatility will expand. Even if it consolidates here for a couple weeks, the implication would be we'll probably get some sort of an elevation like this. It might come in January of next year. But again, not trying to predict, or don't want to try to come up with any type of biases for when I think that will happen. All we do know is the opportunity that's being given to us right now. And right now, the opportunity has been massive consolidations, which have been great, with an expectation in an expansion in implied volatility. And this is a case here in a week in which I got pretty lucky, because we ended up getting both nice sideways consolidation and an increase in implied volatility. And that is not something you will get that creates, in this case, the perfect storm to have really nice returns on a week where I never had to take on much risk. Hopefully this video helps. Again, it's a little bit unconventional. I'm not aware of if there's this type of content being shared online. It is just the approach in which I have. I'm not formally trained to learn how to trade spreads, so it's allowed me, from since I started trading them, to always think a little bit more creatively, or a little bit outside of box, once we understand the functionality behind what each spread is supposed to do. I took courses and classes early on when I first started trading, mostly based on technical analysis. Spreads is something I became self-taught, so it has allowed me to do things that have been pretty wacky and crazy. And whenever I do something that's unconventional, I'll try to pop on and record a video and release it to you guys, so hopefully it can expand your thinking or your approach for whenever you're trying to build out a risk profile. Especially if you're a swing trader such as myself, it's a little bit more calming when you can spend a whole day just kind of planning out how your next couple weeks are going to go in the markets. And that's one of the things that I love most about trading, is you can leverage your time and still make some sort of income, because these are weeks in which you can easily make a couple $1,000s without having to be stuck staring at the chart expecting price to do something. And then you can cover your basis points by maybe buying some cheap out the money call options on the SPY or something like that, if you're expecting some sort of a move. So a cheap strangle is another way in case something crazy did happen that you wouldn't have been able to account for. If you enjoyed this video, leave a comment down below. Let me know if you'd like to see more spreads-based videos like this, and I look forward to having you in the next one. Thanks for watching. It's now Sunday, and since the week is obviously over, I have the results on how some of the trades turned out. I recorded the video on a Thursday afternoon, and about 19 minutes before the market closed on Thursday, the Iron Butterfly was up over 207% return on margin, or about 74% of the total credit received. I was able to close for about 200%, which made the decision very easy to hold the 6 double calendars into Friday, with the expectation that the market would make an attempt for either 4,600 or 4,500, as I had mentioned earlier in this video. Some of the strangles ended up working out well. That's something that I didn't show in this video, but again, expecting that expansion, I had a 5 DTE strangle as well as a greater than 14 DTE strangle. And then this is the results from when I started taking profits for the double calendars. So once trades start reaching around 100% is definitely when I like to take profit. The highest the double calendars ended up hitting was about 133%. That's actually right where they closed, as the SPX closed at 4593. So it was about 7 points from it closing exactly 4600, which would have meant it would have been an amazing pin. But again, I started scaling out once it started hitting 100%, 105%, 110%, and the final take profit was 133. I figured I'd just share this if anybody wants to take notes on double calendars with some sort of expectation for what's your maximum type of profit potential on a week such as this, because the market will repeat itself again. If it sold off to 4,500, it would have been a monstrous win, as it probably would have been up well over 200%. But again, because price rose to the upper side, which was 4,600, implied volatility did come down, therefore resulting of a great return around 100%, versus if the market sold off, it would have been over 200%. Thanks for watching, and hopefully you guys appreciated this edition. Take care.